One of the most common questions I continue to receive is how I am investing my money and really my retirement accounts. It's interesting because I've always been really reluctant in sharing this because, I can't give you investment advice. So I want to be really, really clear that this is not investment advice or really any advice. And before beginning any investment plan or financial plan, you've got to consult with your own team of advisors and really look at your situation, your risk level, your time horizon, your age, your objectives, everything. So I'm just sharing with you what I'm doing, and I'm at possibly a different stage than you are. So just be aware of that. My husband and I have very different levels of risk tolerance. But something happened a little while ago, probably a few years ago. He read an article about a financial expert whose wife said, we need to diversify, we need less risk. And what she said is, we have a lot more to lose if we lost our money than we have to win by making more money. And it got the financial expert thinking. And so he started diversifying some of his money into less risk. And whoever that financial expert is, I want to thank you because it's really helped my husband to get more on board to reducing our risk and, more importantly, increasing our guaranteed income. And oh my gosh, I'm so thankful because it's something that I am more concerned about losing money. And I think part of it is I live in this world. I have seen what happens in the 2008s when, boy, probably the biggest time of my life where I was really just genuinely worried. I thought, what is going to happen? Because when banks start failing, it's a problem. The fact that Obama, who's the president, this is not a political statement, but he took over such a mess. And I remember thinking, and again, this is nothing for or against any political party, but I remember thinking, he does not have the expertise to be able to know what to do. And I was so worried because I thought these banks are failing. What are they going to do? And the fact that not only did they come out of that, but the fact that people were made whole, no one lost money. I mean, it was just nothing shy of a miracle. I think a lot of us, we're not looking at it from that large of a scale. We're looking at it more from our own viewpoint of our money. But it's a great thing to realize that we need to really make sure we've got the right allocation based on our situation. And I know I sleep better at night knowing I have guaranteed income and knowing that I'm working because I want to, not because I have to. So if you want to know how I'm investing my money, you're going to love today's episode. So please stay tuned. Hi, I'm Annette Bau, host of the Wealth Inside and Out podcast and founder of the Millionaire Insider. My mission is to help you simplify the money game so you can create a financially secure and fulfilled life without having to have a PhD or spend countless hours on your finances. You're going to learn how to think like a millionaire, stop worrying about money and wondering if your financial house is truly in order, and instead spend your time doing what you love. With over 3 decades advising 7, 8, and even 9-figure millionaires, and now joining that elite group, I'm in a unique position to help you make the best financial choices so you can create a secure financial future and retirement you love. This is the Wealth Inside and Out podcast. To take your free financial checkup, you can go to themillionaireinsider.com/FC. Most people understand the importance of a medical checkup. A financial checkup is the same thing. In fact, in some ways, it's even more important because if you don't have money, you got to have your health and you got to have money, right? And those two things are really so critical to having a financially secure life you love. But in this checkup, you can just look at different areas and see where you are and, more importantly, what you need to do. So again, themillionaireinsider.com/FC. Today's free resource is our retirement plan checklist. This checklist is literally probably 70 years, maybe even more, combined expertise of what you need to be thinking about and know before you retire. And there are so many powerful nuggets in this checklist. Again, you can go to themillionaireinsider.com/RPC. Millionaire Series copyrights all material and intellectual property. This information is for educational purposes only. It is not intended to replace any advisor or specialist or to provide any investment, financial, tax, retirement, planning, or healthcare advice. And I really want to reiterate this. This is not investment advice. I'm not giving you specifics on stocks. I'm not giving you specifics on bonds or on annuities or anything. I'm telling you what I'm doing, and it's generic 10,000 foot view. You've got to look at your situation before you change anything. By accessing this content, you agree to hold millionaireseries.com and its affiliates harmless for results achieved or not achieved. For today's show notes, you can go to themillionaireinsider.com/76. So we're going to dive into, first of all, rules of thumb for investing, my philosophy and time frame, changes I'm making real time right now as we speak, and why I'm making those changes. So let's start by talking about rules of thumb for investing. And again, these are rules of thumb. This insight does not replace an investment advisor or a financial professional. You've always got to review your situation, your risk tolerance, your time horizon, and your special situations. I cannot stress that enough, my friends. Many experts use a rule of thumb in determining the asset mix. So they say, take your age minus 100 to determine the amount of fixed income you have. So for example, if you're age 45 and you take 100 minus it, you get 55. So 55% of your portfolio would be in stocks and 45% would be in fixed income. If you're 50, take 100 minus 50, 50% would be in stocks, 50% would be in fixed income. If you're 60, 40% would be in stocks and 60% would be in fixed income. Now, that's a rule of thumb, my friends. It's not, again, to replace an advisor, but I want you to think about this. If you're 60 and you have a lot of money, you may not be in that mix, right? Like you got to figure out how much money you need to live on each month. And so let's just say, for instance, you've got a $10 million net worth or $5 million net worth or $20 million net worth. I don't care the number. But if you need $10,000 a month, which is basically what, $120,000 a year, you probably don't need to take 50 or 60% of your portfolio and have it in fixed income. So again, you got to look at your situation. That's absolutely critical. Just to reiterate, I'm going to give you generic, bigger picture. I am not legally allowed to give you specific investments, and I shouldn't be, right? Because I don't know anything about your situation. I just want you to understand how I'm thinking so it can help you to reevaluate what you're doing and what you may want to consider. Now, if you do need additional support, whether it's financial coaching or money coaching, you can go to themillionaireinsider.com/SR for support request. So if you resonate with my thought process, you may want to make some changes in your own portfolio. These are just for you to consider as you go through that. So let's talk about my philosophy and my time frame. I am a long-term investor. And as I mentioned, I have significant assets in other accounts personally. And my husband also has a significant amounts of money in his retirement, as I do. So what we're doing in our portfolio does not represent a huge dollar amount, but it's in our overall portfolio, but it's something that I wanted to do. It was really more my driving it. And then I've done it recently, even more so for some clients. And I think it got him even looking at that and saying, yeah, I really think this is a great option. Some of the changes I'm making, as far as the percentage of my bigger picture, is only about 10%. So it's not like that much. Now, as far as my retirement, it's more like 30%. My pension has hit an all-time high. As I've shared before, I'm mostly invested in stock. I can handle it. Now, I will share this much. One of the stocks I own, it hit like 236 and then it dropped like within 2 or 3 days. I said to my husband at about 230, just sell. I want to get rid of some. We have too much of that stock in retirement and in our personal account, just sell some. By the time he did sell a little bit, but by the time I realized what's going on, I'm like, my God, it's down to 224. And then it hit down 203. Well, today it's back to 225. It is volatile and it drives me crazy. And I shouldn't probably be on my phone for me to watch it, right? I don't invest in single stocks for my clients because I just don't have clients that really can handle that kind of risk. And I'm not going to do trading like from a standpoint of buy, sell. I just heard of this situation where these people got this advisor, purchased really high-tech stock at the absolute highest. It dropped. Oh my gosh, way dropped. They must have had a sell order in because then they sold it and then it went back up. And I thought, that is why you don't do day trading. It's gambling and it's crazy. So I don't do that. As I mentioned, my pension is at an all-time high. It's higher than I could have ever imagined that I would have in a pension. It's just unbelievable. Investing in stocks is not for the weary of heart. It has been hard. I watch single stocks, but I don't I monitor my portfolio probably quarterly, just like I do with my clients, but I'm not like micromanaging it. Because it's hit an all-time high, I started thinking about, it would be a good time to reposition. Now, many of you know, if you're watching what happened to the market, we were over 40,000, then we dropped. Well, now what is it today? Like 40,563. I mean, it's crazy. It's an all-time high. So I want to just say one thing about stocks. I like single stocks. I think it's a lot of work and I think you have to be paying attention. But if you look at history, and again, it's not meant to give you advice, over time, the stock market has on average earned about 10%. Now, the one thing you have to be aware of is that when you have a downturn in the market and then you take money out, you have to make significantly more to break even. And so some people that are managing money, they'll say, well, during retirement, you're going to have all your money in the market, but we just want to let you know that if it's a down year, not to take money out. Well, not everyone can do that. And so for me, I just want to have a certain amount of money that I know it's guaranteed coming in every month. I mean, it just makes me comfortable and I sleep better at night. Like I love knowing that I'm going to have X amount of dollars. Now, I want to be really clear on this. The amount of money that we had planned that we'd have guaranteed income in our portfolio, we're going to actually probably double that. My thought process is you figure out what your fixed expenses are. So hopefully you have your house paid for, you don't have car payments, you don't have debt. So, you look at it, you got to take into account taxes and insurance and food, which Lord knows has gotten very high. A lot of different factors in there. Once you know that number, that bottom line number is what you should be aiming for as far as guaranteeing your income. That's how we are doing it in our house. And and then the other money, it's like, fine, it'll be, invested in growth. We have a lot of money in real estate. We've got money in a variety of different accounts that have, exposure in the stock market. Then I've also got a significant amount of cash because we're right now building a major home. And so we don't do debt. And so that's something that it's trying to balance all of it. But again, you've got to look at your own situation and be really clear on that. Now, I don't need the money and I'm not going to take RMD until I absolutely have to. So right now that's 72. I mean, it's 73, but then you have to take two of them. So it's 72, but that's going to change 110 times before you take any numbers I give you. Go online, search it up or look on the IRS website. But because I've made so much money, I just wanted to take some of that gain and put it into guaranteed income. So this is a huge takeaway that is, again, it's my philosophy. It's what I'm doing, but it's to give you some food for thought. I had always planned that we were going to take personal money to purchase more money in a guaranteed annuity. We already have one in a retirement account, but it was like, we're going to do that with our personal money. And then what I started realizing is that an annuity with personal money is going to be, first of all, taxed as ordinary income, meaning as compared to if you own a mutual fund or a stock, that appreciation is capital gains. Now that could change in the future, but right now that's not the case. Whereas money that you get in retirement is always going to be ordinary income because it hasn't been taxed. So that was one of the things I started thinking about. The other thing I started thinking about is the fact that when you turn 72 right now, hopefully that number is going to keep going up, but at some point you have to take out RMD. You're forced to. So what I started thinking is, if we're taking this income stream from a guaranteed annuity that's in our personal assets, we're going to be forced to take that. Now we've got all this RMD because we are going to just get nailed in taxes when we both have to take RMD. I mean, it's going to be crazy. I mean, I know you can complain about that, but still, our taxes are going to be out of control because there's nothing you can do about it, right? You're getting money and you have to pay taxes on it. In that scenario, you don't have an option. So what I started thinking about and talked to my CPA about it, talked to my husband about it, I said, I really think we should do this in our retirement accounts. Now, it seems a little bit counterintuitive, but in reality, I like that option better than your personal monies because your personal monies, you can be investing them in a way in which when you do take money out, it's just capital gains tax, which is currently less. It may not be in the future, but it is. But it also allows you the flexibility of not having to take it out. Like, how much money do you need? And I mean, hopefully we're going to spend our money and hopefully at some point I'll retire and we can spend our money. But I wanted that flexibility. So just to recap that again, You're forced to take RMD. You don't have a choice when you turn a certain age. Whereas your personal monies, you can let that continue to accumulate and you don't have to take money out until you need it or want to. And when you do, generally speaking, especially if you've held it for right now, it's a year, that could change. You pay capital gains tax on it. So that is significant. Like, I think the first, I want to say, you just need to go look at a chart, but I think it's 0. Then the next number is 15% and then 20%. It's a lot better than the highest bracket. It's just something to be aware of. I'm just going to kind of give you a bigger picture of some of the changes I have made and that I'm making now and why. About 6 years ago, we took around 200,000 of my husband's IRA, invested it into an annuity that offers guaranteed income. It accumulates for 10 years and then it guarantees us 24,000 a year. Now, again, these numbers are just our numbers. They're not that would be what your numbers would be, but we get 24,000 a year for both of our lives. I kind of calculated that based on the fact of my initial goal was that we would have about $10,000 to $12,000 a month of guaranteed income coming in from all the different sources that we have. That particular product also has a long-term care rider on it that can pay long-term care if he needs it for up to 6 years. So it just gave us an additional level of protection. We started talking about RMD, which is required minimum distribution. You have to take it when you're 72. We decided to take another 300,000 of his and put it into guaranteed income. That'll still leave him about 60% in the market in his bigger picture. I started looking at the numbers, and what I found, which I was just fascinated by, is that some of these accounts accumulate, like they have a 10-year accumulation period where it's like again, these numbers, I'm just giving you my numbers. So basically what happens in some of these carriers is they have numbers where the numbers increase by a certain amount each year. And when I started looking at this, I'm like, boy, if I did it now, it was able to accumulate that for 10 years. It's huge as compared to doing it and then starting to take the income right away. And so what I calculated as far as myself is, all right, well, based on my numbers, if we had, say, another 5,000 to 10,000 a month of guaranteed income, that would be huge. I just decided that I'm going to end up being about 30% of my portfolio, and I'm also going to invest it in guaranteed income. And I'm doing 2 different options. One is one that's guaranteed, you know exactly what you're going to get in, I think mine is like 10 years. And the other one, it's got more of a variable where I can get more market growth. And so I thought, okay, it's still guaranteed. I can't lose money, but I can still have a little bit more upside. And so again, that was just right for me. It's not saying that it's right for you. But in the example where I'm talking about, when I started looking at these numbers, because we originally were going to start taking my husband's out in like 4 years. And when I looked at it, I'm like, gosh, if we wait until 6 years, literally it jumped like almost $9,000 a year. It was just unbelievable. And I thought, gosh, it really does pay attention to these things. So I was talking to the company I use and the wholesaler, because I use one of the largest wholesalers in the country that can just look at every option. And I said, what is this? Is this a mistake? And they said, no, there are bands. And so like age 60 is one band, age 65 is another band, age 70 is a band. So the difference between starting to take your money at 69 versus 70 is astronomical. Now, where they get somebody is where somebody has to have the money. So ideally, work 1 more year so you don't have to have the money. But I looked at that and I thought, God, this is a no-brainer. So again, you've got to be aware of that. The other thing that's come up recently, and I just want to address this because my husband and I, our ages, we're 10 years apart, but it's not as dramatic as some people, is when you get these annuities, you can get them on joint life. I think that's really important. It's kind of like a pension. You do not want to have one person not have it. Now, I have a situation right now that when the husband is going to be able to take his money and wants to take it, the wife is not going to be close to 59. And so then there's a penalty. So what you got to do in that case is make sure you have insurance to cover the difference. That's really important. I want to go over now just a couple of reminders. Most people should not be invested in single stocks. They're volatile and they have huge swings up and down. I shared the story of one stock that we owned. I think we bought it at like 170. It dropped to like 97. And I said, let's just double up. So we doubled up, got to like the break point. I said, sell it. And of course, my husband doesn't listen to me. The next thing I know, the stock's at like literally 300. I go, oh, you shouldn't have sold it. He goes, oh, I didn't. I go, you didn't listen to me. That's really disturbing. Went to 600. It split. It went back to 600. I mean, it's just crazy. But it goes up and it goes down. It has huge swings. You got to be aware of that. And that's why most people should not be invested in single stocks and they should not be doing it on their own. You got to first assess your risk tolerance and make sure your portfolio is properly allocated. You got to do this before you invest in money or you start your plan. I just cannot stress that enough. Now, if you can't sleep at night, you are not allocated correctly. I was laughing because somebody online was freaking out when the market went down. And all I said was, I mean, this is great. You really do determine your risk tolerance. You know, everyone's a growth-oriented investor when the market's going up, not so much when it's going down. And I have seen this over and over again. People are like, I'm aggressive growth. And they answer every question, aggressive growth. And I'm like, I don't think you're aggressive growth. You're telling me this, you're saying this, and the market drops and they are freaking out. I'm like, you're not an aggressive growth investor. So you've got to be really clear on that. And you got to know that before the market drops because it's going to adjust. That's what happens. It goes up and it goes down. Now, if you're like me or many women, you love guaranteed income. And we at least want to know that we're going to have our house, we're going to have food, we can do a few things, and we don't have to worry about money. We don't have to worry about getting remarried. We don't have to worry if we need to help our kids out, all of those things, right? There's nothing fun about knowing you have to get remarried. And probably the funniest thing I ever heard is there was a couple in my office years ago. The husband was like, he didn't want to get insurance. And the wife said, do you want me to be forced to have to marry someone else? And he was like, thought about it. He's like, well, that's a good point. It's like, you just got to be thinking about the bigger picture. And that's not exactly what she said, but I'm not going to say on this what she actually said. Do you want me to marry a blah, 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 because I don't have enough money? I've never met anyone who doesn't want a guaranteed paycheck. Like, it's really interesting. People start getting them and they love them. I have never had anyone tell me they have too much money in retirement. Now, I do have clients that do, but no one thinks they do. And so the reality of it is, and especially now when the cost of goods has increased dramatically, we got to make sure we have enough guaranteed income. I was just talking to one of my peers and he said, I was planning on having 4 million investments. I thought that was fine. But now with inflation, I'm rethinking that. I'm thinking I need more. So again, you got to look at the big picture. People who have enough guaranteed income, either from Social Security, from their pension and or annuities, so that their basic expenses are paid and they don't have to worry about money, have more peace of mind and less stress. And I have seen it for the last 3 decades. It is amazing how people show up when they're not worried about money. So I really encourage you to go back and listen to this. Again, that's not investment advice, but just give it some thought and see how it pertains to your situation. And more importantly, what you can do to make sure that you're in line with what you want to achieve and that you're not worrying that if the market does drop or adjust as it's going to before you retire, that you're going to have problems or not have enough money. So there you have it. Let's recap. I provided some of my philosophy and my time frame, which might be very different than yours. So you got to look at yours. In the event that your time frame is different, then you're going to have different type of product. That's the bottom line. And you may have higher amount in risky assets or a lower amount. As I've shared, and I want to reiterate, it's really critical that you reevaluate and that you look at what your objectives are. And as situations change, you adjust. The reason I'm making the changes I'm making right now is because it's just fascinating how well the market's done. If you don't really pay a lot of attention to the market, everyone, right now things are so politically motivated because we have a presidential election. You always see this, but I always laugh where people are like, oh, they're terrible on the economy. And then you start looking at like what has happened in all the different sectors from the stock market, 401k, everything. And you look at it, we have literally been in a growing market for 16 years. The last major adjustment was in 2008. And so again, you just got to be aware of it. But I personally just think, how much higher can the market go? Now, I thought that at 30,000 and we're at 40,000. And thank goodness I didn't take my money out. I had one blurb in there where I took some money out because I just felt a little nervous. And had I not taken that money out, boy, my portfolio would be even significantly higher. It's just something to be aware of. The Dow just closed at $40,563 today. Oh my gosh. I don't even know that that's the all-time high. It might have even been up a little higher, but it's unbelievable. And that's why I'm reevaluating my portfolio. I'm taking 30% and I'm going to invest it in guaranteed income, where it's going to percolate for the next 10 years and then I'll take it. But again, it's a perfect time for all of us to reevaluate our risk, our goals, our objectives, and to continue to reevaluate and to review our situation. For me, I don't want to have to work and I don't want to have to worry about losing money, not having enough money. And so knowing that in retirement, we've got enough money that no matter really what happens, we're going to be okay, to me is priceless. And again, you got to decide that for you. If you need a financial checkup, please go to themillionaireinsider.com/FC. Just like a medical checkup, my friends, you've got to have a financial checkup. So again, themillionaireinsider.com/FC. If you love the content of this podcast, please follow and subscribe to our channel so you get notified of episodes, and also give us a 5-star review and share a comment. We really appreciate it. Congratulations on taking another step to create a financially free life you love. If you're not sure about your financial future or that it's in order, or you are ready to stop worrying about money, or possibly the fear of becoming a bag lady, ending up broke in retirement, or you simply are ready to know your financial house is in order so that you can have a bright financial future, please go to themillionaireinsider.com/NSF. And that doesn't stand for non-sufficient funds. It stands for Next Step Finance. It's the next best step of what you need to do so you can avoid an NSF notice in your future. Again, themillionaireinsider.com/NSF. The number of women who were not broke or poor while working or married is staggering. The entire mission of the Wealth Inside and Out podcast is to ensure you have the information for you, your family, your friends, anyone who's willing to listen to it and apply it so that you can create a financially free life you love. Again, themillionaireinsider.com/NSF. Until our next episode, take one action that will help you create a financially free life you love. I'm Annette Ba'u, your host. All international copyrights are reserved. Bye for now.